Good evening. Thank you very much for your patience, everyone. My name is Andrew Courtney, and I will be facilitating this webinar this evening. So the idea here is to provide you guys with as much solid information as possible. And ultimately, we're here to answer as many questions as we can, but we do have a limited time. So if I can ask you all to write all of your questions by utilizing the Q&A icon underneath here, that would be fantastic. Thank you very much. Before I get started, I'd like to acknowledge we would like to acknowledge the traditional owners of the land which we gather today. We pay our respects to their ancestors and their descendants and recognize their valuable contributions to Australian and global society. Okay, so today we have Nathan Watt, founder of Watson & Watt. He'll be talking to us about, g'day Nathan, about taxes and how to go about planning for the future. And my name's Andrew Courtney, and I'll be talking to you for 5 to 10 minutes about taxes and wealth creation and how it all works within the Get Finance Fit format. So without further ado, let me share my screen with you and we can get started. Okay, excellent. Here we are. So an introduction to the doubling game. I'm not sure if anyone has heard of this particular concept before, so I'm going to be sharing with you what is the doubling game today. So the typical disclaimer for all financial people out there, this is all general information only. Please do not take this as personal advice. Okay, moving on. So what did Warren say? Warren has been making some big moves as of late. When Warren said this, right? An idiot with a plan can beat a genius without a plan. So the idea here is to start planning. So ultimately, when planning out, what you need to do is start with the end in mind. Right? The idea is to create the outcome that you want to achieve within the context of your lifestyle goals, right? And your financial goals, and also utilizing your time, health, and wealth as beacons for short-term, medium-term, and long-term goal setting, right? Because what I find is if you can consider time, health, and wealth when you're planning to move forward, what happens is it creates a North Star for decision-making processes, right? If you can hone in on what you value most in life and start with the end in mind for both time, health, and for all three of them, time, health, and wealth, it makes your decision-making processes much easier for your career, for your money-making prowess, right? For your lifestyle goals and the like, right? It makes it a hell of a lot easier to start planning moving forward, and you won't be so torn, right? So it's not what you earn and it's what you keep. So in finance, you ultimately have 2 key variables that you need to consider, right? There's the income variable and then the capital variable. So if we're working, we're earning an income, right? If you've got your own business, you're essentially earning revenues from that business. Right, so what you're trying to do here is save as much of that as you can to create capital for yourself, right? And then utilize that capital to provide yourself with a return on investment to hopefully grow your capital even further, right? That's the idea here. And at the end of your financial or investment career, you can pull a lever, right, that can replace your income or potentially replace some of your income or even make it more, right? So it all depends on everyone. Everyone's very, very different. So the key here is to start setting yourself some financial goals and to understand, well, what is the end point, right? The typical end point that I always talk to people about is, well, why not just aim for 75% of your income, right? Or potentially 100% of your income. Set a goal, set a stretch goal, and then set a scary goal on top of that, right? Set goals that are income related and capital related, and ultimately they're both intertwined, right? So the double game is this, right? The idea here is to double your net asset position, i.e. the capital that you have in your bank account, right? Or your net asset position, essentially what you own, right? What you own minus what you owe equals your net asset position. What you want to do as an investor, right, is double that, speed that up as fast as possible, right? So if you look at this, the doubling game is this. It's really quite a simple concept but one that sort of blows people's minds if they haven't seen it before. If you've got $1,000, if you manage to double that over a period of time, utilizing different strategies like saving, that's fairly straightforward, you created one cycle, right? So one arrow equals one cycle. You've gone through one cycle. Now, the idea here is to constantly go through multiple cycles throughout your whole investment journey, right? So if you look at this 1, 2, 3, 4, 5, right, from $1,000 to $32,000, right? 5 cycles, you've doubled it 5 times, happy days, you're at 32, right? Imagine if you do that again 5 times over 32, right? So 1, 2, 3, 4, 5, from 32,000 up to 1 million, right? So what you can utilize is multiple strategies along the way to ensure that you're actually increasing the likelihood of speeding up the doubling cycle, right? This is the game that I'm talking about here. We're all playing this game. Unfortunately, some of us aren't aware that we're playing it badly, and some of us are playing as best as we can, right? So my idea here is to just share with you this thing, and hopefully you can take away these concepts and actually start making yourself accountable to playing the game a little bit better, right? Now, imagine if you've got, so everyone's at a different stage. Like some people are starting out, let's say $1,000, others at 32, others at 128, others at 500, right? Some of us are quite lucky. So whilst I'm talking about that, let me just launch a quick poll for everyone, if I may. Just launching a poll. If you don't mind answering this particular poll right here, I'll probably turn it off in about 15 seconds time. I'd love to just see where we're at. Young professional, mid-career, senior, retired, other, maybe a business owner, if there are other business owners out there. I'd love to get you all to click on this poll. We've got 60%. I will stop it at 80%. Okay, so it's predominantly young professional, mid-career. Cool. Okay, nice. Good stuff. Stopping in 5, 4, 3, 2, 1. Brilliant. Cool. So the idea here is to work out, here are the results, to work out here, where do you sit, right? Where is it? Is it around this area? Is it around this area? Is it here? Is it here? Where do you want to be, right? Like I said before, start with the end in mind. How many cycles do you need to go through to actually achieve the number that you want, right? So aim for a number. Is it 2 million, right? Is it 2 mil? Is it 4 mil? Is it 1 mil? Is it 500,000? Everyone's different. Everyone's financial ambition is different. So what you need to do is consider what you'd like to achieve. Right, so calculating your doubling cycle and the rule of 72. It's really as simple as this. One cycle equates to the percentage return on investment on your net asset position, right? So if you start with $1, and if you produce a 2% return on investment per year, it'll take you 36 years to get there, right? If you're getting a return on investment of 10%, it's taking you 7.2 years to get there, and 15%, 5 years to get there. How do you calculate this? Well, you ask yourself, what kind of return on investment do you want, right? You divide that, or divide 72 by that one, equals the number of years. That's pretty much the strategy here, right? So ask yourself, how long does it take you to go through one doubling cycle, right? That's the powerful question. And if you can optimize for a better result, fantastic. You're speeding up the process and you're getting to your goals a hell of a lot faster, right? So the idea here is this, the doubling cycle mechanics. So let's say this particular person right here starts off with $420,000 worth of net assets in year 0, right? Who knows what year it's going to end up in this one, but let's have a look at what's happened here to double the net asset position. The house has gone from 750 up to 900,000, right? So it's gone up by $250,000, appreciated in value. They paid down the loan by $100,000, thereby doubling their equity. Cash savings has increased from 50,000 up to 100,000, right? Obviously that's savings, right? Super has increased from 120 to 240,000. How does that happen? Through super guarantee contributions and the force of the market and the investments associated with those super accounts, right? So the idea here is to work out, well, what percentage did it take, did they get as a return on investment for the whole net asset position over that time frame? And what you want to do is ramp up your return on investment, ramp up your cash savings to invest back into your plan, and ensure that you're not paying ridiculous amounts of taxes, which is what we're going to be talking about today, right? So what you can control is three key things: reducing taxes, saving more money, and investing better. Reducing taxes is the key framework that we're looking at today, right? I run multiple webinars about this, so feel free to look at the link that I'm going to be sharing with you later to go through and deep dive on all three particular aspects right here, right? So what are the tax or strategies that you can incorporate? Nathan will most likely be going through a range of strategies that you can do, but what you need to understand is you need to be able to defer tax if you can, right? Increase your tax deductions. Understand the difference between entities like super entity, right? Super is a trust, right? You can invest in a discretionary trust or a family trust and start distributing the income to people who are paying lower tax, right? So there's a range of different strategies that you can learn, right? The key here is to not dig your head into the sand and hope for the best, right? Hoping for the best is not really going to achieve much for you financially, right? You need to ensure that you're hanging around professionals or reading a ton of books, watching and attending these kinds of webinars, right? And one of the key challenges that I'd love for you guys to take is, because I know half of you are here purely because you want to learn some tips on how to increase that tax return for last financial year. So what I would suggest you do is pick a percentage to invest, right, from your tax return and start the investment process, right? If you are already on your journey, make sure you don't use all of that and buy that nice holiday when COVID-19 drops down, restrictions drop down, right? Create a timeline of events and make sure you understand the difference between each financial year, lowering your assessable income when you can, and maximizing the tax deductions that you can on a year-to-year basis. So if you want to come along and watch a webinar of mine, please feel free to click on this link right here. Actually, let me just quickly share that on the chat button. Feel free to click on this link that I'm sharing on the chat button here and log in, put your details in, and I'll be presenting a seminar. And that next webinar is on next Wednesday evening. I'll be talking about the all-weather strategy, 5 major pitfalls that you need to avoid, and the 6 strategies to double up a hell of a lot faster, right? Cool. So the ultimate game is to play the resource management game as best as you can, right? So ask yourself what's available, make good use of it, save more, invest better, and lower your taxes, right? Get educated, empowered, and financially resilient, right? Incorporate these 3 strategies again and again throughout your whole investment lifetime. I've got a question here. Does it cost a fee? No, it is $0. So please feel free to go on, click on that link if you want to come along and watch me present for an hour. I'm consistently presenting, adding as much value as I can, and trying to increase financial literacy. In fact, get finance fit is one of the key things that I love to do, because I get in front of all of you guys and actually try and add as much value as I can, right? So next steps, connect with me here if you'd like. LinkedIn, Instagram, Facebook, TikTok if you're inclined, and please feel free to give me, send me an email. Thank you very much for your time. And I look forward to hearing what Nathan will be sharing with us very, very shortly. So let me stop sharing and start introduce Nathan. Thanks very much. Nathan here is, like I mentioned earlier, is the founder of Watson & Watt, and he's a dynamic speaker. We've spoken in the past together. He started off the Tax and Tacos, which is actually one of our biggest draw cards for the Get Finance Fit series, and we're glad to have him back here. Unfortunately, we can't have the tacos, and you can't afford the Uber Eats bill that the tacos will present with how many attendees? With 379 attendees. But today, Nathan is going to come in and show us a few tips and tricks to ensure that we save a ton of taxes. Thanks very much for your time. Enter Nathan. Cheers.
Thanks, Andrew. Hi, everyone. So I'm Nathan. I run an accounting and tax business, business advisory business down in Newstead. I'm a UQ alumni from back in 2012 when I did my MBA. So tonight is obviously about tax, and it's on everyone's mind because a lot of us have been working from home. Sorry, I just got a little message there. What does that say? There we go. Can everyone hear me? Yep, all good. Okay. So tonight we're going to focus on a few things around deductions. We'll spend most of the time on the working from home deductions because I know that's the most topical one tonight. But before we get into that, and a few tax strategies at the end that you can use, as Andrew said, to help boost your wealth and spend some money in the economy. But first of all, I just wanted to go through how deductions work. There's a lot of misconception in Australia about how the tax system works and how deductions work, particularly when we've got the immediate asset write-off. So you would have heard the $150,000 write-off. A lot of people think that's a one-for-one. So you spend $150,000, tax department's going to give you $150,000 back. It does not work that way. So I just thought I'd share this quickly with you because it's pretty much sums up.
My new stereo now?
It's a write-off for them.
How is it a write-off?
They just write it off.
Write it off what?
Jerry, all these big companies, they write off everything.
You don't even know what a write-off is.
Do you?
No, I don't.
But they do. And they're the ones writing it off.
Yeah, so as I said, that one sums it up for me. That didn't work very well. Okay, don't worry. All good, not important. Let's move on. So how deductions work. So deductions are only as good as your tax rate. So if you're on an income of $90,000, this little example here, $90,000 of income, a little bit of interest. So you have assessable income of $90,500. Now let's say you spend $1,500 on some deductions this year, leaves you with a taxable income of $89,000. On that, you would pay $22,252. And if you didn't spend any of that $1,500, you would pay a tax of $22,792. So you can see that the tax saving is only actually $540, but you've spent $1,500 in cash. So you've got $960 you're still out of pocket. So deductions, spending money for a tax deduction just does not make sense. Okay, so when people say, oh, you can write it off on tax, yes, you can, but you're still out of pocket the cash. So how do deductions work? Now there's 3 golden rules for spending money for tax purposes. One is you must have spent the money yourself and you haven't been reimbursed. So your employer, if they reimburse you, you can't claim that deduction. It must directly relate to earning your income, and you must have a record to prove it. Now these are all the different types of work-related deductions that we have. We're not going to go through all of them tonight, but this is the work-related deduction section. There's a few other sections in the tax return that we won't go through tonight, but these are the main ones that you'll focus on. So with you're doing a tax return this year, the ATO, keep in mind, are not stupid. They have some very advanced computer systems and algorithms. So they're not looking only for when things have gone up. They're looking for when things should be going down, or if they're staying the same. So vehicle, travel, clothing and laundry this year, if you haven't been working in the office for 3 months of the year, they will be looking at whether or not your clothing and laundry bill is the same as it was last year, or if it's gone down. So if you haven't been working for a quarter of the year, have you really been wearing a uniform at home while you've been doing that work? Same with your travel. If you can't travel down to see clients, they would expect that your business kilometres will be going down. So keep in mind that if that's what you claimed last year, you probably shouldn't be claiming the same again this year. You need to go back to what you've actually spent and update those amounts. So just keep that in mind when you're filling in your tax return. So home office, this is the big one. What can you claim? Well, you can claim electricity, you can claim the cost of cleaning it, you can claim phone and internet, computer consumables like your ink and paper and stuff like that, stationery, pens, diaries, calendars, all that sort of stuff, and hardware, so computers, printers, desks, chairs, furniture, phones, all that sort of stuff. But bear in mind, the immediate write-off deductions that we're talking about before, the $150,000, that doesn't apply to individuals. That's only for businesses. So the individuals have a grand total of $300 they can claim in any 1 year for these capital costs, these assets. So if your computer chair costs you $500, you can't claim $500 this year. You have to depreciate it over its effective life, which basically means how long does the chair last for and depreciated over that period. Now, you don't have to work out how long a chair will last for. The ATO has done that. And on their website, they have an enormous PDF document that tells you what the effective life of assets are, that you can go and look up and find that out. So you basically get the cost. So $500 divided by 8 years or whatever that number is equals the amount you can claim this year, multiplied by your business use. So if you also use that chair for gaming and other things, you have to pro rata your deductions. If you spend less than $300 on any of that stuff, you can claim it in the year that you buy it. So a new mouse, new keyboard, $100, you can claim that straight up. What can't you claim? You can't claim tea, coffee, milk, toilet paper, any of the stuff that work would normally provide in the kitchen. I know it sounds, you might think that's unreasonable, and I'd probably agree with you, but it is the way it is. Businesses have different rules in regards to deductibility than individuals do. So even though you're buying more coffee because you're at home or using the toilet more because you're at home, you can't claim that excess expense. You can't claim anything to do with your kids or their education while you're homeschooling them. Even though you're trying to keep them quiet with the iPad, you can't claim that against your income, because we go back to the golden rules. It's not directly related to your income. So that's out. As I said before, you can't claim anything that your employer has provided or reimbursed you for. So if they give you a laptop or monitors or chairs or whatever it is, cables, you can't claim that because you obviously haven't paid for it. And you can't claim your rent, mortgage, rates, or insurance. The table on the side runs through the different things. So the only way that you can claim occupancy costs, or what they're called, so rent, mortgage rates, insurance, stuff like that, the only way you can claim that is if you're running a business from your house. And the classic example is you're running a hair salon from downstairs, you have a couple of chairs and sinks, clients come to your house and get their hair done. That is running a business from your house. If you have a home office where you take phone calls and work from home a few days a week or even full time, that is not the principal workplace, so you can't claim the occupancy costs. Move on. So how do we actually calculate these amounts? Well, there's three methods. The new one's a new limited time only method that the ATO came out with, and you've probably seen it in the papers, on the news lately. Fixed rates has been around for forever. They've updated that rate and the actual cost. So let's run through those. So the shortcut method, it's a new one they came out with. It's really easy to implement. It's actually fairly generous in some respects, depending on your actual cost. So it's 80 cents per hour that you work from home from the 1st of March to the 30th of June. So it's not for the whole year. So if you work from home at any point from July through to February, you can't use this 80 cents an hour method for that period, only from March to June period. So you can't claim every hour that you're there. It's not 80 cents times 24 hours times 7. It's how many hours did you work, less your meal breaks, so your lunch or whatever. So normally that would be 38 hours or 40 hours times 80 cents. It's $32 a week that you're claiming for about 12 weeks. So, and then multiply that by your tax rate. So it's not a lot of money, but it is an easy way, or it's an easy method to use. So you actually have to be working. It's not just emails or phone calls, being on call, that sort of stuff. You're actually working. A good benefit of this is you don't need a dedicated work area. So you don't need a dedicated office or a study. You can be working on the kitchen table or the bench and still claim this. If you have multiple people in the house who are also working from home at the same time, you can each claim 80 cents an hour. You don't have to pro rata between you, which is handy. But the downside is you can't claim anything else. So if you've gone out and bought a new table or a chair or whatever it is, monitors, you can't claim any of that stuff and the 80 cents an hour. You only get to claim the 80 cents. So no phone, no internet, all that sort of stuff. And the only record keeping you need for this is to keep a record of your hours. So your timesheet, your calendar, all that sort of stuff, or your pay slips with the hours that you've worked on it. Now the fixed rate method is pretty popular. You'd probably use that for the rest of the year. So from July through to February, it's 52 cents an hour. But if you have multiple people in the house all working at the same time, you'll have to pro-rata that amount because that 52 cents an hour covers things like electricity. So you're not all you're not all incurring additional electricity costs, so you have to split that between the people. You need to have a dedicated work area. So this one, you can't claim it if it's just the kitchen bench or the kitchen table. You need to have an office or a room you can convert it into an office, and that's its only use. The good thing with this method is that it's only for those running costs of the room, so electricity and things like that, heating and cooling. So you can claim, in addition to this amount, your business use of your phone, internet, consumables, depreciation on the chairs, computers, all that sort of stuff. You do need to keep a diary, and when they mean diary, like your calendar showing the hours you've worked. That's sufficient. You do need the receipts from Officeworks or JB Hi-Fi or wherever it is, your phone bills, internet bills. Phone bills, it's a little bit ridiculous, but to work out the business use, you need to go through the phone bill and work out which business calls that have been made versus the private calls that have been made, and that's how you establish your business use. Now, actual cost will need you to get a tape measure and measure out the dedicated area and divide that by the total area of the house. It'll also need you to get your electricity bill and work out the average kilojoules that you use and the average units you use per hour, and then multiply that by the number of hours that you've actually worked. So in other words, it's really painful, but it can provide you with a bigger tax deduction if you have, a fairly large office or a lot of equipment that uses a fair bit of electricity. In general, most people, I would suggest, will get the best result from the 52 cents method for the least amount of work. It's the fallback for us that we use a lot for clients, so I'll be looking to use that, but make sure you have your records that you can actually claim it. So the shortcut method is easy, but it may not result in the biggest refund if you had to buy equipment or increase your internet or your phone or anything like that. But the good thing is you could run each of these different calculations if you wanted to and use the one that gives you the best result. But they're the ways you can do it. So big disclaimer on this is the record keeping is key this year. The ATO is going to be all over this. So make sure that you can justify and substantiate the amounts that you're putting in there. Because they will be looking at this, and it may not be straight away, but they have a couple of years to come back and have a look at your tax returns. So make sure you've got the documents there to support your claims. Some deductions that you might miss. Depreciation is an easy one to miss. If you've bought a computer in a previous year and you haven't rolled that depreciation over into this year, it's easily lost and forgotten about. If you subscribe to any industry journals that cost you money, or books or newspapers that are specific to your industry or your line of work, you can claim that stuff. For example, if you're a real estate agent, you can claim the Saturday paper because it has a significant property portion in it. If you're a stockbroker, you could claim like the Financial Review. If you're in business and you try and claim the Courier Mail for its 2-page business section, you're going to struggle. So it needs to be pretty comprehensive and have a fair bit of information in it to be able to claim it as a deduction. So it can't be, I'm in business, so I need to know about general business, therefore I'm going to claim the Australian. That's not going to cut it. It needs to be really specific to your industry and your job. Income protection is a tax deduction if you pay for it outside of super. So if your super fund is the one that owns the policy, you don't claim the tax deduction in your personal return. But if you have an income protection policy in your own name, you can claim that against your income. And donations, they're easy to lose, those receipts, especially if you put a few dollars in the tin as you walk past, that sort of stuff. You can't claim that because you don't have the receipt. So you need to keep that sort of stuff. If you are going to give donations, make sure you get a receipt from them. And also make sure that they're a deductible gift recipient. So you can be a charity, but still not be able to get a deduction for the donation. So they need to have a specific designation called a deductible gift recipient. So where you see a receipt saying all donations over $2 are tax deductible, that organisation has gone to the ATO and got special clearance and a special designation for that. So if you're thinking of giving a donation and you're not sure, you can look it up in the Australian Business Register and see if they are a DGR. And if they are, you can claim it. If they're not, you cannot claim that as a tax deduction. I know there's not many business people here, but if you're thinking about a business, I'll give you some tax hacks that only businesses can get. And this isn't a sole trader business. This is a business that has a structure. So a company or a trust, and you are an employee of that business. So a self-employed person can do this as long as they have a company or a trust that's actually their employer. So some tax-free groceries, thank you very much. How you get a tax-free lunch and overtime meal allowances. So none of these things are going to make you a billionaire. It's not cheap stations, but every little bit adds up. So tax-free groceries, how do we do it? This is based on, all these strategies are based on fringe benefits tax, but there's no taxes payable. So this one is irregular and infrequent and not part of your salary package. Think employee of the month or the quarter. You've done a great job. You smashed your targets. Your boss gives you a gift card to Woolies or Coles, and it's less than $300. So it can't be $300. It needs to be less than $300. It's a tax deduction to the employer. There's no fringe benefits tax and there's no GST on gift cards, but it's not assessable income to you. So that's basically tax-free groceries. So you're getting tax-free groceries. How much money would you have to earn to pay for $299 worth of groceries? If we think back to the first couple of slides on how the deductions work, and do some algebra, it's the gift card value divided by 1 minus the tax rate. So if you're on the 37% tax rate, so you're only between 90,000 and 180,000, you would have to earn $475 before tax to get $299 in your bank account to go and buy your groceries. So it's a pretty handy little tax saving. So if you do this a couple of times a year, you get a gift card, you could easily be saving, $500, $600 a year on your groceries. Now, this is specific to, it's not all gift cards can do this, it's specific ones. So Woolies, Dan Murphy's, Bunnings, stuff like that. If you're going to do that, please get advice before you do it. Tax-free lunch. So food provided on work premises on a work day is exempt from fringe benefits tax. It's also a tax deduction to the employer, and it's not assessable income to the employee. So $20 per week, maybe that's 1 or 2 lunches a week, times 48 weeks, because you have some holidays. That's $960 worth of lunches. $960 divided by 63%, again a 37% tax rate. That will change depending on your specific tax rate. That's $1,523 a year. So you're saving about $550 a year in taxes by eating lunch at your desk. So that's a pretty good one. It can't be part of your salary package, so you can't agree with your boss and put it in your contract that you'll take some lunches instead of some pay. It doesn't work like that. It has to be just an ad hoc little bit of benefit. Sorry. Overtime meal allowances. This is one of the ones that sort of breaks the golden rule that you need the substantiation. So you don't need to keep written evidence in some cases. So if you get paid an overtime meal allowance under an industrial award, so whatever that award is, hospitality award or whatever it is, food and drink and consume it on overtime, you can claim up to the reasonable allowance limit of $31.25 and not pay tax on that. So you can spend $30 on your dinner while you're working overtime. You don't need to keep a receipt for that. If you spend $40, you need to keep a receipt for the $40. If your employer doesn't put it on their pay slip, on your pay slip, you don't need to record it in your tax return. So this is a good one if you do work overtime to make sure that you're getting paid for that. Of course, if you're working overtime and your employer pays for it and you have it on premises, again, it's tax-free to you. So just a couple of little tax hacks that can save a few $1,000s for those in business. But as I said, if you've got a business, don't go running out and do this without getting some advice on it. So tax strategies anyone can use. So this one's for employees. You don't have to be running in a business. The first one's a vehicle. So this can be a 0% business use. So your private car that you go to work in, go to uni or whatever it is, you don't use it for work at all. A person earning $90,000 a year can save about $1,800 a year on a $30,000 car. Now, that's not a one-off benefit. That's year after year after year. $1,800 tax-free. How do we do it? It's a little bit more complicated than tonight's session. It's probably a session in itself. But basically, you're playing with fringe benefits tax versus income tax versus GST. So if you want to try and do this, you need to talk to your employer to see if they offer salary sacrifice arrangements, because they don't have to. But it could be a good one to say, hey, this isn't really going to cost you much, and it would be a nice little bonus for me. They will need to do some more administration and lodge fringe benefits tax returns, so they'll have some accounting fees and things. But if you can pitch it to them, this could be a good one for you to get a nice little bonus. And use that $1,800 to start your doubling strategy with Andrew. Residential investment properties, everyone knows that you can get a negative gearing deduction for those, but there is a separate one that you can use where you salary sacrifice expenses. So where there's lots of GST, so not your interest, not that stuff, but things like body corporate fees, agent management fees, repairs, where it's got GST on those. Normally you can't claim GST on investment properties, residential investment properties, only on commercial. So this one works because when you salary sacrifice, you don't salary sacrifice the GST portion. So you're saving that little marginal amount. So that's why the repairs need to be quite significant. The GST expenses need to be quite significant to make it worthwhile, but they can be there. Really important that those repairs are repairs and not improvements. Otherwise, the whole thing doesn't work and you'll probably end up paying tax. So again, get advice before you go off and do that. Some record keeping, you need to keep all these receipts and documents for 5 years from the date of assessment, not 5 years from the end of the tax year. So if you do your taxes in May each year, you have to keep the assessment from that day that the tax office sends out the notice. How do we keep records? Well, there's a few different ways to do it. You try and keep it as simple as possible. The ATO does have an app. It's called My Deductions. It can do your logbook for your car. It can do all sorts of stuff in there. Depending on how comfortable you are with the ATO knowing your details and what you're going to claim, it's up to you, but they're going to find out soon enough. So you can get that one for free from that website. You can also just have a folder in your email. So if you're getting emailed receipts and invoices, just create a folder called Tax 2020, drag the emails into there, and then your filing system is done. Alternatively, you can have Dropbox, Google Drive, hard drive, whatever it is. Again, just save it there as you get the receipts and the invoices and emails. You can create a folder in your camera roll on your phone and take photos of the receipts. A lot of those receipts fade anyway, so you need to photocopy them or whatever. So taking a photo is quite easy. You can use Excel and NetBank to categorize your expenses and your income, but you still need the underlying receipt and the invoice. So bank statements themselves or credit card statements themselves don't count as substantiation because you don't actually know what the amount was, and it's not a tax invoice. So if it just says Office Works, you say, well, that was ink. The ATO has nothing to prove that it was actually ink. So you need to keep the receipts. Lastly, if you're in business, you look at software programs like HubDoc or Receipt Bank, but for an individual, you wouldn't bother with those. But if you're in business, they are worth their weight in gold. And that's it. So there's a bunch of questions that I've seen come through.
Yes, it looks like we've got about 37 questions, mate. So we might just quickly rattle a few off really quickly and try and get through as much as we can. We've only got 15 minutes left, ladies and gents, so please bear with us. Quick question. So you mentioned bank statements, obviously not enough, so that's fair. Would a desk set up in a common area of your house be considered a dedicated workspace?
No.
Cool.
Simple one, no.
So when supporting a partner financially, can they claim expenses related to that partner's living cost?
No.
I receive a per kilometre allowance for travel undertaken in my privately owned car. These payments form part of my taxable income.
Yes. So you would get the cents per hour as income, and then you would claim the business kilometres as a deduction at 66 cents or whatever it is this year. So you need to keep track of the actual kilometres you're doing and then claim that against that allowance.
All right. What's the difference between getting a professional doing tax returns and doing it by yourself?
Depends on how hard your tax return is. So if you're salary and wage with 1 or 2 deductions, probably not much. And I tell people all the time, have a go at my tax and just do it yourself. But if you've got investments or a business or anything like that, or a lot of deductions or odd circumstances, you might want to pay someone to have a look at it, because it can get quite complicated. But if you're just run of the mill, you go to work and you've got professional memberships or whatever, just do it yourself.
Cool. For those on a working holiday visa, it is not compulsory to file a tax return. Is it possible to file for a tax return on a working holiday visa, and can you receive a tax return if you're below the tax-free threshold despite their international status?
That's a curly question. That's a good question. Yeah, I don't see why not. Yep, let's go with yes.
Cool. All right. Can we claim a deduction when an employer has not reimbursed the expenses in FY 2020, but may or may not reimburse the expenses in FY 2021?
You probably want to get clarity from your employer before you lodge your tax return. So they should be reimbursing, I'd say soon. So I'd be asking them to make sure you're not going to get reimbursed for it. So if you are, you just don't claim it. Yeah.
How you feeling there, mate? You're getting through it pretty well, mate. Well done. From what can you claim slide, does occupant expenses mean rent?
Yes. Yeah. So anything to do with occupying the premises, so rent, the interest on your mortgage, insurance, rates, that's all to do with the occupancy. So you can't claim that stuff unless you're running the business from your house. Yeah.
For the shortcut method, can you claim consumables like printing paper?
Just 80 cents an hour.
Okay, cool. So while you're talking about that, so what if I work full-time at work, so I'm eligible to claim the 80 cents per hour in brackets, and I also freelance after work hours? How do I treat those freelance hours? Also an 80 cents per hour during COVID, or can I use the old method of 52 cents per hour and claim on electricity, etc.?
Yeah, you could do it. You could do a hybrid. You can't claim the 52 cents an hour and the 80 cents an hour at the same time. So you have to pick one for that 3-month period. Sorry. 3-month period. So whichever one you use. So you can use the 52 cents method or the 80 cents method for the freelance as well. It doesn't have to be just an employer, but you just have to pick one for that period.
Okay. I received pay on the 1st of July for a time period of the last 2 weeks of June. I work casually. Does it count in the FY 19-20 or 2021 FY?
2021 it should be. Yeah. It's a payment for the employee. It's the payment date that's critical. For the employer, it's the other way.
So I've got a question for you, Nathan, like back to record keeping, because I'm sure like everyone saw a bunch of the points that you've got there on that particular slide. What would you personally use if you were to go back into time with your knowledge right now, just finishing the majority of our audience here tonight are young professionals? What would you personally be using for record keeping?
Like Google Drive or Dropbox or something. Like
okay.
Probably just take a photo or get the PDF and just drop it in there and just leave it there. Yeah.
Yep. Just create multiple years for different financial years essentially, and just drop it in there and off you go. Awesome. Good stuff. If the electricity and internet bills are in my housemate's name, but we share the cost, can I still claim a portion?
Yeah. Yes, you could. You'd have to get something from them to say that you've paid them for it. So they'd have to basically charge you for it, I suspect. Yeah.
And so this is another one. If I'm not in the house lease, can I still claim if I have a dedicated work area?
Sorry, what was that?
If the person's not in a house lease, can they claim if they have a dedicated worker area?
They're not on the lease, but they're living there. Yeah,
I assume so. Yeah.
yeah. If you're responsible for paying the electricity and things like that, then yeah, you can claim the cents per hour. So it's not who owns the house or who's on the lease; it's who's paying for the expenses.
Okay, here's one. I would like to use the fixed rate method and claim the tax for my new computer separately. I bought the PC last year, but they weren't working from home. Can I claim it from this year onwards? And how should I calculate the percentage on the PC?
Yeah, you can, but you need to work out the date that you bought it last year. Run the depreciation until the date that you started using it this year, and whatever that value is. So if you bought it for $1,000, it's depreciated down to $700 by the time you started working. You start your depreciation at $700 this year for the work period. It's called the written down value, but you need to take into account the fact that it's not brand new.
When I went into the ATO website, I clicked tax lodgement income tax. It shows no tax returns are due at this time. How can I claim the tax return online?
It may not be due yet, but you should be able to lodge it. I'd recommend you probably wait a week or two to make sure you've got all the information from the banks and employers, because even your employer doesn't need to report just yet, not until the 14th of July. So you need to wait till that's all finalised. But once all that's done, you can lodge it online through MyGov, MyTax.
Nathan, when do you think is the best time to do some tax planning? Because obviously the financial year is just finished. Is it March, May, April,
Now.
June?
Right.
Now.
Right
July.
now.
Okay, July for this financial year, obviously.
Correct. Yeah, for 2021.
Okay, because it's too late for previous financial year.
Yeah, you can't shut the gate after the horse is bolted. So if you want to put in place some real tax strategies like salary sacrifice, you need to do that now. You can't do that in June because it's not going to make any difference. So if you want to do any of that sort of stuff, you need to do it in advance. Things where you're spending money doesn't really matter. Like if you go and buy a new computer, it doesn't really matter because as long as you've got the receipt, you can claim it. But any real, anything where there's some decent money involved, you need to do it in advance. Like you can't claim your super contribution now for last year. Like you've got to have a plan to do that in advance.
Yep. I'm a translator, and if I subscribe an industry magazine paid in foreign currency and have a receipt in another language, can I claim this? And how does it work? Thank you.
Yeah, you can, but you need to be able to translate that invoice into into English, and the dollar amount into Australian dollars. So if you go to if you've got the actual currency conversion amount, you can use that. If you don't, you go on the ATO website and use their foreign currency amounts. But you need to translate that receipt into English and keep them both.
And for the depreciation that you mentioned, if I bought an iPad for work and claimed it last year, do I claim anything for it this year, or no, because I already claimed that last year?
I suspect it was over $300, so you should have depreciated it last year. So there should be some balance to claim this year. But if you've claimed it all last year, there'll be nothing left to claim this year.
The simple one, Don. Do we need a license to do tax return?
Only if you're charging someone for it. So you can do your own tax return, doesn't cost you anything. You can do your mate's tax return as long as they don't pay you a fee for it. If you're paying anybody a fee for a tax return, they need to be a registered tax agent.
Cool. How does one become a registered tax agent?
You have to study, and then you have to apply to the Tax Practitioners Board and meet all their educational requirements. Once you've done that, you register and you get a certificate saying you're a tax agent and keep up your CPD. Yeah. If you go to it's called tpb.gov.au or something like that. There's all the requirements on that.
So how would one calculate the percentage for an internet bill?
Good question. Technically, the answer is you go through and you work out what you did for business on what days and the megabytes that you used and against personal. That's the technical. Most people run off a bit of one of those ones.
Does the tax-free lunch work with working from home with a dedicated area?
Unfortunately not.
With the $300 gift card, less than $300 gift card limit, is it one per financial year, or you mentioned irregular or rare event? How many times per financial year if you can make it irregular?
Well, there's no set amount. It's more of the pattern and what it was for. So you might be able to get 6 or 8. You might get 4. Just depends what it is. Like if it's every quarter on the quarter, it's going to look a bit weird. If it's 3 this year and 5 next year, as long as you've got justification of why they were given, then that's okay. It just can't be that every 6 weeks you get a gift card, or every month that you get a gift card. It needs to be an ad hoc sort of thing, that it's not anticipated and it's not expected, and it just sort of happens a couple of times a year. I know it's a pretty grey answer, but it's a pretty grey section of the law.
If I donate $3K to a registered organisation, what amount can I claim back?
All of it, provided it's not a political party and a deductible gift recipient. If you're in a loss position, you can't claim, obviously, because you don't get any tax benefit anyway. But yeah, all of it.
How do you prove the hours you've done, as my company doesn't keep timesheets or any records of the hours put in working in banking, so the hours are long?
You would just need to keep a diary evidence of, or login times to your computer or whatever. So yeah, just your own personal calendar or diary that you work the hours. If you had if you're logging into a computer system, then you might just log in, the time you logged in and logged out, and the dates.
Cool. I got a question here for me. Andrew, what is the best way to get started with investing? How do we know what to invest in? Well,
Bitcoin.
Bitcoin. It's a tad late for that one, but yeah, it may be a viable option still. Feel free to go into the chat area and actually click on the link that I'm putting on there, and I will be covering a webinar on that specific topic for you guys. But it's a hard question to answer. Ultimately, what you need to do is get into the habit of saving more than what you currently earn. Get that habit going, and then start looking at your options. First port of call, if you want liquid, i.e. funds that you can pull out straight away, is Raise. That's an app that you can get straight away. You can get some exposure in some market, different asset classes. So that'll get things moving for you. That's RAIZ. But if you want to do a little bit more strategic stuff, you need a little bit more money as well. So really the idea is to just accumulate and build the resources around you and utilize it at the right time. So coming to these kinds of webinars will help you actually formulate a bit of a plan of attack for yourself. Do we need to pay taxes on the money received by a partner from JobSeeker?
The person receiving JobSeeker will pay tax. The partner wouldn't. Yeah, so it'll just go into their tax return as income and get calculated as normal. So if that's their only income, they'll probably be under the tax-free threshold, so they wouldn't pay any, but yeah, it just gets added to your tax return.
And if that job seeker wasn't paid out and there was a lump sum because they were waiting on a particular point and it was paid out, let's say in July, that would be considered a new financial year income, I'm assuming. Is that right?
Yeah. So Services Australia will send you a payment summary, or they won't send it to you. It'll be in my of amounts that you've received for your normal payment summary.
Yep. If your professional membership is more than $300, can you only claim $300 worth of it as an expense that year?
No, you can claim the whole lot. So the $300 limit is only for assets. So things that last for more than a year. So your computer is going to last for more than a year, so you claim a deduction for it over multiple years. Okay, and Nathan, where can we find you, mate? Do you have social media handles? Do you have websites that we can visit, the audience can visit if they need some help, if they want to set up a bit of a meeting with you? Do you have an offer potentially for the audience? No, not really. You can get me at watsonandwatt.com.au. Or on LinkedIn is probably the best spot. I do have Facebook and Instagram, but they're not very good, so just don't worry about those. Just go to go to LinkedIn or the website.
Nice. Good stuff, mate. Well, thank you very much, everyone, for attending. We do have a next financial event, Get Finance Fit event in September. It's about investment. So the person who's asking, where do we start? That's another one that you can go into. There will be a survey at the end. So please tell us what you think. We're trying to make this thing better. We seem to hit a good spot here with the webinars. So I'm glad that a bunch of us are showing up to this thing. So I'm sure we'll keep doing it for you guys in the very, very near future. So we're open to suggestion. We're trying to make things better for you guys. So make sure if you've got any feedback, good, bad, different, or indifferent, or ugly, feel free to share that with us. And if you want to follow me and learn a little bit more about finance as well and investing, please feel free to follow that my Instagram account. There's a property report there. If you're interested in buying a property as well, just follow the links and just reach out if you want any help. So thank you very much, UQ Young Alumni Advisory Board, for hosting and helping us make this thing happen. Izzy Ko, who is the stalwart of this program, thank you very much for your time, for all the effort that you put in, and obviously the advancement team at UQ. Thank you very much, the UQ community as well, for coming along. And Nathan, thanks very much, mate. Appreciate your time.
All good.
Brilliant. Thanks, guys. All the best. Yeah. Recording is going to be available to you guys. Make sure you answer that survey towards the end there. There's going to be podcasts and videos as well. Cheers.
Cool. Yeah.
See you guys.